And welcome back to the Halftime Report. I'm Bob Pisani. Time for ETF Edge. Oil prices inching higher after OPEC said it would keep cutting production, albeit gently, as tensions in the Middle East grow hotter. This follows President Trump's tweet Sunday that any further threats from Iran will lead to, quote, the official end of Iran, close quote. The moves are breathing life into some energy ETFs, but where should investors be looking to buy? Let's drill down. Dave Nadig of ETF.com is here, and Ann Bartels of Bank of America Merrill Lynch. And Ann, oil is up this year, but in your opinion, is it really fully pricing in the possibility of a genuine conflict in the Middle East?
Absolutely not. They're looking at the oil market, it's balanced, but when we go out and look at the December options market on Brent crude, they're only pricing in a 10% chance that you can get a move to 90. So we don't think any conflict is actually priced into the market.
Could we go to 90 in a real conflict?
You could go to 90 in a real conflict.
Yeah. Dave, we've talked about for a long time how to play oil when it moves.
Right.
There's a problem with these oil ETFs. OIL is one of them. Of course, you're basically buying into, these are futures contracts, and you're buying into the next month future contract. Usually it's more expensive, and so you get a decay of your investment over time. How do you deal with that problem? We've had this for years and years.
Well, right now it's not such a big problem. The implied annual cost of that roll is about 3%, which is about as low as you can get without going all the way into backwardation. There is a fund that solves this problem, which is DBO, which does a mixture of contracts to try to minimize the damage that contango
Does it actually work? Does it?
It does work. If you look over the last 3 years, when we had some periods of really strong contango, it beats the pants off any front month strategy. But if you look in the last year,
so you like DBO as a oil if you're owning oil
for the long term,
and this is still futures contracts.
Pure futures contracts.
Ann, you like XLE. This is equities, of course. Why do you like XLE? This is the biggest oil ETF, equity ETF out there. But there's a lot of choices. There's oil exploration and production like XOP. Why is this better than any other oil ETF out there?
Well, it's well diversified, and we do have a model, and we look at how our analysts are rating their stocks. We look at technicals. We look at the efficiency of the fund, and when we combine it all together, that actually scores the highest in our model. So we like the XLE.
And the more diversified names, the Exxons, multi-channel names, they're doing better than the exploration and production companies this year, at least. But there are periods when that doesn't happen.
It definitely, that's true. But at this point, when we look, again, I think the heavyweight is what our analysts really like at the firm. We really weight them very heavily within our models, and they're a little bit more tilted towards the integrated.
The real story is just the decimation of this sector overall. It's about 5% of the S&P 500 by market cap. So it's hard, even when Exxon's up on the day, to get that group to really move the market.
Yeah, you really have to be in energy if you want to take advantage of these kinds of geopolitical moves.
Okay. Thank you, guys. Always a pleasure to see you. Dave Nadig, Ann Bartels. Thanks very much.